Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the concept of income attribution. There will be follow-on videos from this when we discuss ways to circumvent or to set up legitimate tax planning measures that will help us to get around income attribution. But for this video, we're just going to look at the basics of attribution. So what attribution refers to, you'll need this definitely at the financial planning level. This is important if you're going through a securities exam or your mutual funds exam. For life insurance, for the LLQP, this is just on the fringes of what you need to know. So the attribution rules at their surface, it's good to be aware of them for the purpose of the life insurance exam, but they're not a heavily tested concept on that exam. So maybe a quick watch of this video will suffice for exam purposes. Definitely from a real-life planning perspective, this is actually quite important. So attribution means we're going to attribute or source back income to the person who's responsible for generating that income. And the most common scenario where we're going to see this is with a couple, and this couple might be married or common law. And common law for the purpose of income tax means that you're living together for either 12 months or without having lived together for 12 months, you're raising a child together and the relationship is conjugal, is a conjugal relationship, which means you hold yourself out publicly as a couple. So in order to have a concern around attribution, normally you're going to have this kind of scenario. We've got a couple here, and in this couple we've got spouse A and spouse B, and spouse A has a good income. Spouse A, let's say, makes $180,000 a year, and spouse B has relatively low income. Spouse B maybe just works here and there and makes $20,000 a year. So spouse A, depending on the province, is going to be at a tax rate somewhere in the 40 to 50%-ish range, a little lower in Alberta, but roughly in that 40 to 50% range, whereas spouse B is going to be at a tax rate somewhere in the 20 to 30% range. So we can see that we would rather have income in spouse B's hands. And here's what we might have. So let's say that this is, for the both of them, their employment income, and then spouse B has some investment income. So let's say that spouse B also has $20,000 a year of investment income and spouse A has no investment income at all. So this would be their investment income. And we can see then that this investment income for B is going to be taxed at this low rate. However, and this is where we get into trouble, the question that would be posed here and how the Income Tax Act would treat this, the Income Tax Act says, hang on a second here. Where did spouse B get the funds from to earn $20,000 of annual investment income? This doesn't make a lot of sense. B only makes $20,000 a year. That seems like a pretty big stretch to have generated that much through investments. So the assumption here, and probably correctly, would be that in fact A has given B the funds to allow B to go and make these investments. And as such, this income that we see in spouse B's hands should be attributed back to A and therefore taxed at that 40 to 50% tax rate. So this would be where we would have income attribution. And the onus would be on the couple, on A and B, to demonstrate that in fact this $20,000 is properly supposed to be taxed in B's hands. So if we can't show that B actually purchased or acquired the source of revenue for this $20,000 of investment income on their own rights, then this attribution will happen. So the onus is on the couple. The assumption, the way that our Income Tax Act is written, is that otherwise A is the source of this investment, whatever investment it is, that's generating this $20,000. So attribution is of greatest concern in two sets of relationships. So obviously then, as we've said, attribution is a concern between spouses or common law partners. And attribution is also a concern with minor children. Now, with minor children, it's important to note that there is no attribution of capital gains income. So if a minor child has some investment income in the form of capital gains income, that's not going to generate an attribution concern for the most part. Other sorts of income, like interest and dividends, would have attribution concerns for minor children. For the most part, we don't have attribution concerns in other relationships. So it's less likely that we have attribution concerns outside of just these two relationships. And for the most part, we should assume that this is not going to have attribution. I should mention that with minor children, this would include your child. This would also include a niece or a nephew who is a minor. So those attribution concerns apply to, again, your child or a niece or nephew. And in a future set of videos, we're going to look at ways to get around the attribution rules, legitimate tax planning opportunities that are available to us to help deal with the attribution rules in relatively clean manners. And really what we're trying to do, we're trying to accomplish what we didn't accomplish in this scenario above. We're trying to get A to have legitimately $180,000 of total income, and B to have legitimately $40,000 of total income. And in fact, if we can move more of that income over from A to B, so much the better, although there has to be a legitimate method of doing so, and this is a place where taxpayers often do fall afoul of the Canada Revenue Agency owing to the specific provisions to prevent this. So I hope this is a good introduction to the attribution rules and helps to demonstrate that we can't just pick and choose the taxpayer who's going to pay tax on $1 of investment income. You can look forward to some later videos describing the ways to deal with this. Thank you very kindly. Enjoy your continued studies.